Welcome to the Financial Jungle. This is Sharekhan Podcast.
Good evening, everyone, and thank you for joining on the call. The world is today in a unique and difficult situation impacted by the coronavirus. This has impacted our physical and mental health due to health risk and also personal loss of loved ones. It has also impacted our financial assets due to the economic consequences of the lockdown. We at Sharekhan hope that you and your families remain healthy and urge you to stay safe during this tough situation. With regard to your concern of financial portfolio, my team and I are here to support you in every way. Please do not hesitate to reach out to us for any concern, query or clarification relating to your portfolio or investment. Today, I bring you an opportunity to hear from an industry expert, Mr. Manishi Raychaudhuri, for a global and regional perspective on the impact of coronavirus. Manishi is Managing Director and Head of Asia Pacific Equity Research and also Asia ex-Japan Equity Strategy at BNP Paribas Securities. He is based in Hong Kong and leads a team of equity analysts and sector heads across various locations in Asia. Manishi has 24 years of work experience, of which more than 10 within BNP Paribas. He has previously worked as Head of Equity Research at BNP Paribas Securities in India. This call has been organized for Sharekhan HNI clients, and I would like to thank you all for your continued patronage and your time today to listen to us. Manishi, thank you for taking out time for us, and now the floor is yours.
Thank you very much, Jean-Christophe, for that introduction. I hope I'm audible to the audience in India. Thanks a lot for this opportunity to speak to our esteemed clients. What I'll do today is that I'll first give a very brief introduction of the global situation today, and because we know that this is an unprecedented economic downturn, I will try to touch upon what are the various different channels of transmission to economic growth or economic decline rather of this COVID-19 contagion, the kind of economic growth forecast changes that we are seeing both from ourselves and from other agencies like IMF. Briefly, we'll talk about the monetary and fiscal stimulus, because that's a very important point that would decide what would happen to global economies after this period is over, after we have put the COVID-19 contagion behind us. And finally, I'll spend a few minutes on India specifically, because I understand that the clients are predominantly interested in the Indian markets, and even in my job description as an Asian equity strategist, India is a very important part of our coverage, and we run an Asian model portfolio, of which India is a very important part. Great. So without further ado, let me briefly talk about each of these points. First of all, this COVID-19 related economic slowdown that we are seeing today, it is unprecedented. This is something that we have never seen before, possibly not in at least a couple of centuries now. Because this is not exactly a financial crisis, which the global financial crisis of 2008 was, but this is a health crisis which is forcing a near complete absence of economic activity. And it's important to understand that, because other fiscal crises, like what we had seen during GFC, they can usually be countered by fiscal and monetary stimulus. When central banks inject money or governments actually dole out cash through fiscal action, they basically tell consumers and companies that, okay, here's some free money, go ahead and spend it. But under the present situation, everything is under a lockdown. And under this lockdown crisis, those fiscal and monetary stimulus can't work because the consumers are all locked in at home. Right, so this is one very important difference that we must remember. There are various channels of transmission of this, the COVID-19 contagion to economic growth decline. Possibly the most obvious and the most important are the decline in domestic economic activity due to a partial or total lockdown. There's a broad-based decline in consumption demand and disruption in supply chains due to shutdown of factories and non-availability of workers except for the non-essential services. Second, there is a obvious decline in travel, tourism, and various leisure activities. And therefore, the countries with significant revenue from tourism, for example, they tend to suffer the most. So countries like Thailand, in the Asian context, which have tourism revenue almost at about somewhere around 4 to 7% of GDP, are turning out to be a big sufferer in the present scenario. Third, decline in commodity prices. We have seen a spectacular decline in oil prices. It was, of course, triggered by the discussions within OPEC and Russia falling apart. But even after a recent understanding within OPEC and Russia and the United States, oil prices haven't really recovered. After a brief rebound, they're again drifting down, which means that it's actually consumption demand, which is the bigger concern now, rather than supply-side discipline. And oil is just one example that I gave, but in reality, most other commodities like coal, copper, aluminum, they're all facing a similar kind of downturn at the present point. Number 4, global trade. As a consequence of demand destruction, and particularly in the developed economies, global trade is suffering. In fact, for much of Asia, which are the export-dependent countries in North Asia, it's actually the decline in global trade which is dragging down the economic growth of these countries. And finally, capital flows. Capital flows are actually the lifeblood of emerging markets. But during these times of economic uncertainty, capital flows tend to gravitate towards the so-called safe haven destinations, like developed market bonds, like US Treasuries or gold. Consequently, the emerging market currencies, and particularly the Asian currencies, also Latin American currencies, they tend to depreciate, and this is more concentrated in the countries which have a current account deficit. This is actually important in the context of India. We have seen in last 2 months or so, the Indian currency depreciate by about 5 to 6%. We've seen the Indonesian currency depreciate by about 12 to 15%. That's been the worst performer, followed by South Korea, which has declined about 4 to 5%. So this is another important driver to keep in mind, because this decline in domestic currencies means that companies which have US dollar debt, they tend to suffer. And on the other hand, the companies which have US dollar revenue, like IT service companies in the context of India, they tend to gain. As far as global economic forecasts go, they have been cut down very sharply. We have seen this morning how the International Monetary Fund is now talking about a minus 3% global growth. And as early as January 2020, they were at a plus 3.3% global growth forecast. So the global growth forecasts are dynamic. And not only that, even after this recent cut, the IMF has emphasized that the risks are still to the downside. BNP Paribas global economists have also acted in a similar way. They have cut down global growth forecasts to minus 2.5% for 2020. And these cuts are actually driven more by the developed economies at this stage. So, for example, United States GDP growth is forecast to be minus 5.7% this year, and it's been cut by about 5% recently. 95% of the US population are under some form of lockdown or a stay-at-home order. So in China, the growth forecast currently in 2020 is 1.5%. In Japan, it's minus 4.2%, and in Europe, in the Eurozone as a whole, it's minus 8.3%. So these are the BNP Paribas Global Economics Group forecasts at this point. As far as India is concerned, Indian growth estimate is 2.7% in 2020. If you ask me, my personal opinion is even that may be a bit of an overestimate. But as I said right at the beginning, that for all these growth forecasts, the risk is to the downside. These are all dynamic forecasts. They're kind of moving targets in a volatile scenario that we are living in. I must also mention that both independent agencies like IMF and our Global Economics Group expect a rebound in 2021. So, for example, BNP Paribas economists are talking about 5.8% positive growth in 2021, partly because of return of the workforce and reopening of the workplaces in the second half of 2020, and also as some kind of a delayed effect of the fiscal and monetary stimulus that we have seen. In fact, this fiscal and monetary stimulus, that's been huge. That's possibly the silver lining, which shows that governments and central banks are pretty much throwing everything at this problem, and they are determined to, basically to control the economic contagion at whatever cost, at whatever fiscal cost that can be imagined. In fact, we believe that the total fiscal bill for the developed and emerging markets combined could reach almost about 15 to 17% of GDP. US has unveiled a fiscal package of $2 trillion. That's about 9 to 10% of GDP. That's huge by US standards. In case of China, the fiscal deficit target itself has been raised from 2.7% of GDP to about. They are also planning more tax cuts and administrative fees. In Japan, the total size of this fiscal stimulus is about 17.3 trillion JPY, Japanese yen, and that's about 3.5% of their GDP. In case of India, somewhat surprisingly, I would say that the total size of the fiscal stimulus at this point of time is relatively small. It is essentially a relief package for informal workers and the poor population, which was announced a couple of weeks ago. And the total quantum is about 22.5 billion, which is about 0.75% of GDP. So if it's actually given in a targeted manner, it can still be effective, but it is significantly lower than what most of the other large economies have announced till now. In addition to that, we have also seen monetary stimulus, which comes from the central banks, like the US Fed. They have pretty much done what they did in 2008. They have cut down the interest rates to near zero right now. And they have also opened up new emergency lending facilities. So there's something called a Main Street Business Lending Program in the US, which is a targeted support to non-investment grade businesses. They have also started something called a Paycheck Protection Program. This is a specific loan designed to provide direct incentive for small businesses to keep their workers on payroll. This, in the Indian context, one would possibly recognize this. Prime Minister Modi has talked about, he has actually urged businesses, both large and small, to keep their workers on payroll. But, in the other large economies like in the US or in the European region, it's not just an appeal from the government, but it has also translated into actual fiscal allocation or money allocation from the government, which would induce the businesses to keep their workers on payroll. So this is one difference between what the other markets, other economies are trying to do versus what the Indian response to the problem has been. Central banks in pretty much everywhere, they have cut interest rates and they're trying to inject more money. In the process, there's one curious element that we've seen, and this is something we've seen in emerging markets also. So there's no difference in this respect, at least, from what we've seen in the developed markets and in the emerging markets, though the quantum has been much more in the developed markets, in the US and Europe. Finally, when it comes to equity markets, as we have all seen, after that initial downturn from mid-February to late March, we have seen a bit of a bounce back in equity markets. So over past, let's say 3 weeks or so, the markets actually bottomed out somewhere around 23rd or 24th March. And since then, over past 3 weeks, markets have moved up by about 15 to 20%. So if I look at the BSE Sensex in the Indian context, it bottomed out somewhere around 26,000. It has come back to somewhere between 31 to 31,500. So it's a similar margin. And we are seeing that at least in Asia or in the emerging markets, the market's perception of the ability of governments to control the spread of the virus, that is deciding, which market outperforms more. So just to give an example, it now seems clear that China has actually been reasonably successful in controlling the spread of the virus in their own country, at least from the formal data that we get from China. And they did it by imposing a complete lockdown only on one province, the Hubei province. And now, after that lockdown was lifted sometime in third week of March, we are actually seeing many of the high-frequency economic indicators in China coming back to their pre-crisis levels. So the kind of indicators we look at, like power or coal consumption by the power plants, or the passenger traffic in the underground railway system, the MTR as they call it in China, in the large cities like Beijing, Shanghai, and Guangzhou, these are gradually coming back to the old levels, the pre-January levels. So I think the ability or the market's perception of the ability of governments to control the spread of the virus, that plays a significant role in deciding how the market would behave. Second, we must also focus on the phase of the contagion that a country is in. So China or East Asia, like Hong Kong, South Korea, etc., they were in an earlier phase of the contagion. The next set of countries that suffered from that contagion were in Europe, and then came United States and possibly India from sometime in early to second week of March. And finally, of course, relative valuations across markets and sectors, that also decides investor behavior. Now, so with this introduction, I'll just talk briefly on India, as I started off by saying that the Indian lockdown is actually far more severe than in many other countries. India has effected a total countrywide lockdown, which most other countries, if I look at the large countries, have not done. It's been, in case of China, it was just one province, which was under total and complete lockdown. In case of United States, even though 90 to 95% of the population is under some kind of a stay-at-home order, the magnitude of the lockdown and the stringency is different in different states. So in case of the United States, it's basically the different states that have decided what to do with their resident population. In case of India, the proportion of informal workers is also much higher than in other Asian countries and let alone the developed economies. Even compared to other Asian countries, it is actually significantly higher. And since their compensation levels, their incomes depend on, much shorter term time intervals, the burden of lockdown and not being able to generate employment falls disproportionately on the informal worker universe. Again, on the positive side, Indian economy is not dependent on exports or tourism. It is largely a domestic economy. So to that extent, India is relatively protected. And finally, India is a commodity importer. So, in fact, we did a study a couple of months ago where we looked at the total indebtedness or, the kind of correlation that manufacturing businesses have, manufacturing margins have with commodity prices. And pretty much all across Asia, commodity price decline leads to an increase in the operating margins of the companies. And this tendency is actually more pronounced in India because, India is a commodity importer, and as a consequence of commodity prices going down, it usually results in input costs of most of the manufacturing companies declining. Also, the decline in oil prices that we have seen, that should help the current account of India. Usually our current account deficit is in the range of 2 to 2.5% of GDP. I think in fiscal 21, the year ending March 21, it could come down significantly, which at some point of time should support the currency also. So right now, of course, we are seeing wholesale or lock, stock and barrel capital movement away from the emerging markets into the safe havens. But once this risk-off sentiment is behind us, I think some of these oil importing countries' currencies should be supported. Finally, when we talk about the Indian markets and sectors, valuations have declined considerably. So if I look at 1 year forward price earnings multiples or price to book multiples, it is significantly lower than the long-term average. And this is all across Asia, in fact, all across the world today. In the context of India, it is about 1 standard deviation below the long-term average. Though, earnings estimates for India could still be at risk. When I look at the consensus EPS growth estimates for Nifty or MSCI India, I still see a number of somewhere close to, high teens, about 17 or 18% for fiscal year 21. And that looks like an overstatement to me. Because some of the, for some of the sectors, let's say like financials, banks, I see a number close to about 25 to 30%. I think even for some of the commodities like metals and mining, the number has not been revised down adequately yet to factor in the kind of decline in commodity prices or product prices that we have seen. So, what we are seeing now is a consistent decline in earnings estimates that we would possibly see across most sectors, if not all. And we would continue to see that during this upcoming result season, which is the January to March quarter, which would be reported now over next 1 month, and possibly also in the April to June quarter. In fact, for the relatively smaller companies whose cash flows are at risk right now, we could even see some credit events, where they are unable to pay back their loans despite the moratorium that they enjoy right now. But eventually, in the second half of this year, after the moratorium expires, we could see some of those credit events as well. This is, while we have seen a reasonably good bounce back in equity markets, I think in the short term, we have to tighten our belts and prepare for some of this adverse news to come through. If I consider sectors in India, fortunately, there are a few sectors in India, and the Indian market offers a reasonably good array of stocks as well, which are good quality, which have good management quality and disclosure standards. First, I'll talk about the consumer staples sector. This whole COVID-19 contagion is actually resulting in some durable changes in consumer habits. For example, and this is the best example that I know of in China, we're seeing a clear increased focus on e-commerce, food delivery, social media, etc. And therefore, some of the game designing companies, some of the e-commerce companies, they're gaining rapidly. In case of India, the greater focus on sanitation or hygiene could be beneficial for some of the consumer staples companies which are in that sector. We have already, in addition, seen some of the healthcare companies benefit from the increased demand for certain specific kind of drugs like HCQ from the developed markets. So, and some of these consumer staples companies also tend to gain from commodity price decline because that's an important input for them. Second, private sector banks, particularly the large frontline private sector banks, which are lending to retailers, and mostly those are collateralized lending. They continue to gain market share, and their asset quality seems safe. In contrast, the non-banking financial companies could be at risk because I think at some point of time they could face the risk of their retail asset quality deterioration, which is largely uncollateralized. Third, I would point out that the oil price decline could help the marketing margins of some of the oil marketing companies in India. And this is a very kind of companies, it's a subsector which is kind of unique to India. Finally, and I had mentioned this earlier, we are seeing emerging market currencies depreciate. It could continue over the short term. INR depreciation is obviously good for exporters and US dollar earners. So IT services, especially the large frontline IT companies, are the prime examples of companies who could derive such benefit. On the other hand, one should stay away from companies which have US dollar debt. And in the context of India, we have such companies in the metals and mining area. We have such companies in the telecommunication area. Even though telecommunication, I think, some select few companies might gain, but, it's not a sector that one can paint with the same broad brush. So this is, what I feel about the Indian market specifically. I will actually stop here and wait for any questions that, the audience or JC you may have.
Manishi, thank you for this useful insight. We collected few questions from our clients, so I will start. Based on your understanding of the situation in Asia and globally in the world, do you believe India will recover faster or slower than other economies?
Well, that's a tricky question because, there are both positives and risks as far as India is concerned. As I mentioned earlier, that in the context, basically, the problems that the economies are facing are not just from the spread of the virus, but the measures or methods the various governments have adopted to control the virus. And these governments have no choice, really. So, one needs to look at the stringency or the quality of these measures. And when it comes to that, the Indian lockdown is possibly much more stringent than what has been adopted in some of the other countries in the Asian region. So, like I'm sitting in Hong Kong, there's no lockdown here. The restaurants, etc., they're open. They have to maintain social distancing, of course. But food delivery is okay. I'm coming to the office every day. So I think in case of India, the lockdown measures have been more stringent, number one. We also have far higher number of informal workers who depend on day-to-day earnings in case of India, and therefore income losses and demand destruction could be higher over there. I also pointed out that at least as of now, the quantum of the stimulus that India has injected is actually much lower than what most of the other countries have done. So these are possibly some of the near-term risk factors as far as India is concerned. On the other hand, India clearly benefits from lower commodity prices, particularly lower oil prices. And it has a largely domestic economy, which does not really have to depend on global trade or global tourism. So I would think on balance, if I were to put all this together, India would also go through a long drawn-out adjustment process like the Asian or global markets. It's difficult to say that India would recover earlier than the other markets in the emerging or Asian universe.
Thank you. According to you, is there a fear of more protectionism measures that will follow after the crisis? Or do you think the nations will come together to recover globally?
Right. You see, some trend, over the long term, some trend towards what we call deglobalization that can't be ruled out. Because, it's now clear that, the extent of contagion that we have seen was partly because of the explosion in, people traveling across the world, the explosion in tourism, and also, the risks to the supply chains that we are seeing. It's also because the manufacturing facilities across the world are so spread out, and particularly in the Asian region. So it would not be, unreasonable to expect that many countries across the world, particularly the developed countries, they may want to have some part of the supply chain back in their home countries. We have already seen that from, the administration in the United States. They have been exhorting the U.S. companies to at least partially move back to the United States. We have seen a very specific program announced by Japan. When the Japanese authorities have actually earmarked about, a little more than $2 billion to help companies relocate their supply chain back to Japan. So, I think some degree of deglobalization can't be ruled out. But having said that, I must also point out that the supply chains today are so well spread out and so well entrenched in some of the countries that it's difficult to, sort of change those suppliers overnight. What we may see is some degree of diversification away from single location manufacturing facilities. So, if a company has a disproportionately large manufacturing facility in China, let's say, which produces, let's say, about 70 to 80%, then that company would possibly try to diversify away from that single location. And as a consequence, some other countries in this region, which are able to offer similar quality of technically qualified manpower or similar infrastructure, may also tend to gain. So we have anecdotally seen, some textile manufacturing moving away from China to Vietnam and Bangladesh. Over the longer term, maybe over the next 3 to 5 years, we could see some of the, electronic hardware manufacturing or even engineering goods move away as well. Though, of course, the manufacturing companies would have to look at the infrastructure availability and the skilled manpower availability to arrive at those decisions.
Thank you. There are many managers and fund managers who believe that over a few years, there is a very nice opportunity to invest today, and that India growth story is still on, even if short term is very painful and shaky. What's your opinion about this?
Right. Yes, in fact, I would agree possibly with both conclusions. If an investor, it all depends on the time frame of investment, the time horizon of investment that an investor has in mind. So, if an investor has a time horizon of, let's say, 3 to 5 years, or maybe even longer, then this is a good time to invest, because such an investor can, I wouldn't say ignore, but he can actually tide over the volatility that we're likely to see over the next 3 to 6 months. If an investor is relatively more short-term focused, then this may not be exactly the right time for him, because, as I said, over the next 1 or 2 quarters, maybe till sometime in the second half of the year, we are likely to see the kind of volatility that we are seeing now. Because much of the economic impact and much of the impact on corporate revenues or the impact on asset qualities of the banks are something that we have not seen yet. We will gradually begin to see them in the April to June quarter and possibly more in the second half of the year. So in the short term, one should tighten the belts and brace for more volatility. In the longer term, maybe over the next 3 to 5 years, I think the good quality stocks would continue to do well, and as a consequence of the valuation decline, they are currently available at much better valuation, much better prices than they were about 3 months ago.
Thank you very much, Manishi, for this clear answer. I think we'll stop here now. So thanks a lot for sharing your views. Thanks everyone for attending this chat. And stay at home, stay safe, take care of you, and have a nice evening. Thank you very much, everyone.
Sharekhan's in-house research desk may or may not subscribe to the same views and may have different recommendations to offer. Statistics mentioned during the session have not been verified by Sharekhan. This conversation is for educational purposes only. The information and views shared herein is not intended to be and must not in isolation be taken as the basis for an investment decision.